up, let's talk about a little about what exactly is factor investing. What does it entail? How is it different essentially from, a regular form of investing? Well, essentially, the idea behind factor investing is that a specific attribute of a company is used to be ranked and be included in a portfolio. Essentially, there are 4 to 5 factors that are taken into consideration when deciding whether a company should be included in the portfolio or not. This could be quality, it could be volatility, it could be growth and value as well. But you know what, let me now bring on board the experts to talk a bit more about this method of investing. Prashant Joshi, the co-founder and partner of Fintrust Advisor, joins us now on the show. Prashant, many thanks for joining us today on ET Now and on The Money Show. It's a pleasure having you with us. To start with, Prashant, introduce factor investing for us. I mean, it's a relatively new concept in India, and of course for retail investors, I'm sure many of them may be completely unaware of what exactly it is. So why don't you start off by introducing this method of investing?
Yeah, thank you, and thank you for having me on the show. So factor is any characteristic that can explain the risk return of a group of securities. Factor investing uses single or multiple factor to analyze and explain and build the investment strategy. There are broadly 2 categories of factor investing: style factors and macro factors. So usually some of the common single style factors are like quality, value, alpha, low volatility. And when you combine 2 or more factors, you might result into a factor like a quality, low volatility, which is a 2-factor framework. Macro factors are basically factors which does not impact the asset price in a very expressible manner, but on a broader factor, they would affect the asset class, like inflation, interest rates, examples of that.
So what exactly are these, factors? And Prashant, is it easy for a retail investor who may not be having much financial know-how to be able to identify companies? Let's say this individual is just starting off investing, Is it easy for, an individual who's just starting off investments to be able to identify these factors, or is it too technical in nature?
For a retail individual or a beginner, it might be a bit technical and require a level of expertise. Hence, the factor indices comes quite handy, so that it does majority of the workload and sort of gives you an access to a pre-specified filter which you want to deploy your money into.
I think we seem to have lost Prashant's feed out there. Prashant?
Yes. Audible?
Okay, all right. Okay, we have him. Yeah, Prashant, so, you were talking about essentially. Yeah, we were talking about essentially retail investors putting money in this theme of investing. How would you rate it in terms of, return predictability? Because, when you say that, okay, I am going to be investing perhaps only in value stocks, or I'm investing only in those stocks that have low volatility, does that make returns as well a bit more predictive?
Well, predicting returns is anybody's guess, as I am, and it's very difficult to do that. Despite having a strong empirical data, it would be not right to predict a return basis what is empirically proven. But what it does is that it tells you that the characteristics that you want to build a portfolio on are accessible, and your expectations of returns would be basis the performance of those characteristics, which you might be expert in tracking that.
All right. Now let's talk about, let's say if we have to consider, and I think this is something that you've spoken about in your table as well, in one of a report as well that you have done, and your research that you've done on these factor funds, which by the way are also called as smart beta funds. The last 1 year, your report suggests that largely the Nifty Alpha 50, the Nifty Low Volatility 50 has managed to do pretty well. In fact, it's outperformed the Nifty 50, in the last 1 year, 5 years, 10 years as well. What do you think has aided that? What has abetted that kind of outperformance?
So, see, factors are basically what you are referring are single factor indices here. And what happens is that during a course of a time, these single factors do have a dominant force in the market, just what like happened in last year. So last year, low volatility, alpha, and even to some extent momentum did fantastically well. And it is attributable basically to the economic cycle, the dynamics during that cycle, and how they favor a particular factor. So I think there's all the forces in the economy were sort of favoring alpha 50 volatility and nifty momentum. So hence in last 1 year you see certain returns.
So what are the market circumstances that we have seen, which has caused this kind of outperformance? And let's say if, we see a down cycle, what can we expect from these smart beta funds then, based on the kind of investment strategy they have?
So see, different factors display strengths and weaknesses in various economic and market environments, and with one factor outperforming in one environment while other doing better in another environment. So at Fintrust, we divided the market cycles namely into three parts: up cycle, down cycle, and flat cycle, and had few observations there, which I would love to share. The key observation on single factor is that starting with the down cycle, which you asked us, during the down cycles, usually Nifty low volatility 50 takes the center stage and performs well, followed by Nifty quality 30. In an up cycle, usually Nifty alpha 50 is consistently performing, followed by Nifty 200 momentum. And in a sideways market or a flat market, usually Nifty 200 quality 30 does well. Coming on to the observations of multi-factor, which we did our study, usually all the multi-factor tends to perform well as they sort of counter the cyclicality of single factors. And in up cycles, they deliver average returns. In down cycles, they deliver above average returns. And during flat cycles, they take the lead. So usually this is how the study of various market cycles and our observations can be on the factor side. However, the important thing to note is that multi-factor indices perform well, deliver better returns over mid to long term with a low volatility across various cycles and provide stability.
All right. So multi-factor returns tend to deliver better, multi-factor funds, tend to return better returns in long periods of time. Another observation from your from your sheet and your report is that when we look at maybe the last 1 year or the last I think even 3 years, maybe 5 years rather, interestingly we have not really seen the multi-factor ones from the more broader end of the market do as well. So just to make sense of it essentially, or rather the single factor ones. So if I have to compare a Nifty 200 with what the Nifty 200 quality 30 has done, the Nifty 200 has actually done a little better. So is it that when we expand the scope, when we are taking the smaller cap companies or rather the mid cap companies as well, the single factor ones or the multi-factor ones tend to lag a little bit?
So we will look at it from a perspective that there can be short period of times where factor indices can underperform to the broader indices. This can be because during a specific time frame, the market capitalization based indices may give slightly more weight to stocks with favorable factor characteristics, which are contributing currently at that point of time. However, single factors are more responsive and cyclical. Now coming to the Nifty 200 quality 30, yes, there has been an underperformance. However, if you look at the other broader factor of Nifty quality 30, it has outperformed the markets. Momentum 30, sorry. So I think it will be difficult to say that which sector sort of on a short to mid term sort of performs better in the market. However, one thing is clear that only a factor with a strong underlying economic rationale as well as most robust empirical support should be considered while investing.
Okay, understood. So, that's about factor investing. Now the question is, what's the place it occupies in a retail investor's portfolio? Usually we put large caps, mid caps, small caps in our mutual fund portfolio. What is the suitability of these factor funds?
So coming to the suitability part at Fintrust, we believe that there is no one size that fits all framework for funds or and to investors. If we take a closer look, we would see that factor investing allows for identifying funds subject to one's return appetite and investment style. So maybe a investor who prefers aggressive growth, a high beta may be preferred by him and shunned by investors who seek a steady returns. Similarly, in an economic adverse scenario or a business cycle, quality factor indices provide a basket of high quality stocks. A high beta and momentum indices may help outperform in case of expected up move. Where the risk reduction is the top priority, factor exploiting low volatility or low risk factors like low volatility could be ideal. And suppose the investor prefers a style of a value style and looking to options to participate. In this case, the value factor indices are ready reckoner. So to summarize that, basis the investor requirement of factor funds, it can be used to target various market cycles, reduce risk, increase alpha, reduce cost, substitute the index, or improve diversification isolation. And in terms of allocation, it is not to be replaced or not a replacement perfect to a passive or active strategy. It coexists in the portfolio.
All right, well, there you have it. That's all about factor-based investing. It could get a little technical sometimes, but that's why you have experts like Prashant and of course the entire mutual fund industry as well that can guide you and of course do the heavy work and the heavy lifting for you. If you have any questions on this method of investing and the suitability and which are the funds as well in this which adopt this kind of investment strategy, well, write into us. Our email address is themoneyshow@etnow.tv. That's where we will be answering your questions and queries. If you want to know about any fund that's deploying the strategy, write in about that as well. Okay, well, let's take on board our first question. Lakshmi Kudre writes, can you please quote a retirement plan that generates a 12% return? Now, Lakshmi's question does have many more questions that I'm sure Prashant as well would like to ask her. But ideally, Prashant, if you had to create a retirement plan, what would be the constituents? What would you avoid keeping? And is a 12% return reasonable on an annual basis, or is it asking for too much given the current environment?
Current environment is a short environment where we are seeing from last 18-24 months. It should not impact in any way our long-term guidance. It should be definitely brought down. And yes, 12% is a bit on the higher side to expect on the retirement planning. So I do not know the current investments targeted towards retirement planning. However, with the kind of returns she is targeting 12%, you should look into equity-oriented retirement funds, provided you have a tenure of more than 7 years and can withstand volatility.
I think volatility really is the name of the game, and if you are already retired, you may not really be able to withstand too much of volatility. So that's something as well that you should keep in mind. Okay, we have our next question coming from Tishar. He says, I want to invest in a multi-asset fund given the current market condition. What's your view of it? Now, this is a very interesting one, Prashant, and I'm going to actually extend this question not just to multi-asset funds, but essentially asset allocation and diversification itself. Because what a multi-asset fund does is it invests in all the three most commonly used asset classes: equity, debt, as well as gold. So does it make sense to put all your money in a multi-asset fund, or do you think that you should instead choose an equity MF and then maybe a debt MF or some fixed income schemes and have some gold investments as well? What would you pick, and what are the pros and cons of a multi-asset fund?
So a multi-asset fund is basically targeting a strategic asset allocation on a long-term basis. If an investor has the time and the expertise to pick up within each asset class of fund, and then at a broader asset class, gold, equity, debt, manage allocations and sort of rebalance them over a period of time, it can be definitely done by an investor himself. However, if there is a paucity of time and expertise, a multi-asset fund definitely helps a lot and takes this key role by a fund manager who is expert in this area. Now, multi-asset fund is basically for a person who is not willing to assume higher risk and is targeting consistent, low volatility returns, low volatility and low returns with an investment horizon of 7-year plus. So that's where it comes in handy. And please note that, as I said, that current market conditions should not be a guiding factor for asset allocation. Instead, your goal and your risk profile should be the guiding factors.
All right. Okay, so that's of course about multi-asset funds, the pros and cons as well as explained by Prashant. Our next question is from Vijay Lakshmi P. Vijay Lakshmi says, I'm 58 years old with no pension plan. I have an 80 lakh corpus, out of which 20 lakhs is in debt funds since a year. The debt fund plan is in short-term funds and PSU and banking funds. Now she says that she needs 20 lakh rupees in 2 years for her daughter's marriage. What will be the corpus for a 25,000 SWP for 25 years at 10%, and is this the right approach that she's adopting? So I don't know, what she's done out of the balance 60 lakh rupees in her corpus. She's 58, 20 lakhs is in debt funds, and she needs that 20 lakhs in 2 years, so perhaps putting it in debt funds makes sense. But yeah, Prashant, what would you advise? What should her overall portfolio look like?
So the amount required for daughter's marriage is something which the goal probably is fixed, and such a money should be at the most safest option possible. Hence, in today's scenario, a bank fixed deposit or a liquid fund will be an ideal option. On the second part on asset allocation, no, I don't think it is right to keep all amount in debt. One could look at investing at her age at maybe up to 20% of equity allocation for the part of money which she can set aside for 7 years.
Okay, well, I just have a follow-up question there, Prashant. Is it the right approach, when you have 2 years left for a goal to be achieved? In Vijay Lakshmi's case, it is her daughter's marriage. Is it the right approach to, what she's done is she's parked it in debt funds? Is that the right thing to do? Let's say if someone right now has money in equity mutual funds, their goal is approaching, markets as well are at record highs, right? So is it a good idea to perhaps book out a little and start putting it in debt funds as the goal approaches?
So when the goal approaches, irrespective of where you are in the market, it is most prudent that 3 to 4 years before the goal to shift the money to a debt instrument which sort of gives you a stability and predictability without the loss of capital. So it is irrespective of whether we are at the peak of the market or the bottom of the market. And yes, this is a good approach that 2 years prior to her goal, she has kept that money into a debt instrument.
All right. Okay, well, on that note, we're completely out of time. Prashant, really appreciate you joining us today on The Money Show and, explaining this concept to all of our viewers. I hope it's enlightened them. Folks, if you have any follow-up questions, do write into us on themoneyshow@etnow.tv. We'll be happy to take on board this topic once again. And with that, we will just wind it out on this particular segment. But when we return, we'll continue the topic in our Meet Your Fund Manager segment. We'll be bringing on board the fund manager of the DSP Equal Nifty 50 fund, which deploys a single factor based investing, or is called as a smart beta fund. And guess what? It's actually outperformed large cap funds, which are actively managed too. So stay tuned.